The numbers tell a story politicians aren't sharing. After a year of trade war rhetoric, China's trade surplus hit a record $1.2 trillion in 2025. American households are paying $1,200 more annually due to tariffs, and both countries just signed agreements that quietly de-escalate tensions while maintaining strategic competition. Goldman Sachs projects U.S. growth at 2.6% and Chinese growth near 5% for 2026, but the composition of that growth reveals a fundamental shift in global economics. Morgan Stanley warns of new inflation pressures, while economists identify China Shock 2.0 as Chinese manufacturers move up the value chain. What actually happened in 2025, and what does 2026 hold? U.S.-China trade relationship has experienced significant changes throughout 2025, with periods of escalation followed by diplomatic agreements. This video provides an objective overview of what happened, the economic impacts, and where things stand now. Timeline of key events. Early 2025, tariff escalation. In early 2025, the Trump administration imposed tariffs on Chinese goods, with rates reaching 145% at their peak in April. China responded with retaliatory tariffs, bringing their rates on U.S. goods to 125%. May 2025, first trade agreement. On May 12, 2025, following negotiations in Geneva between Chinese Vice Premier He Lifeng, U.S. Treasury Secretary Scott Bessent, and U.S. Trade Representative Jamieson Greer, both countries agreed to reduce tariff rates from 125% to 10% for China and 145% to 30% for the U.S. for a 90-day period. October-November 2025, major breakthrough. Following meetings between Presidents Trump and Xi in October 2025, the two countries reached a comprehensive agreement. China agreed to suspend retaliatory tariffs on U.S. agricultural products, including chicken, wheat, corn, cotton, soybeans, pork, beef, and dairy products. The U.S. lowered tariffs on Chinese imports by removing 10 percentage points, effective November 10, 2025, and suspended heightened reciprocal tariffs until November 10, 2026. December 2025, current status. On December 23, 2025, the U.S. Trade Representative announced findings on China's semiconductor practices, but delayed additional tariff implementation until June 2027, with an initial rate of 0% for 18 months. Economic impacts. Consumer costs. According to the Tax Foundation, tariffs imposed in 2025 amount to an average tax increase of $1,200 per U.S. household for 2025. Economists note that tariffs are paid by importers and often passed on to consumers through higher prices. Agricultural sector. U.S. farmers, particularly soybean producers, faced challenges when Chinese buyers reduced purchases during the height of the trade tensions. As part of the November agreement, China committed to purchasing at least 12 million metric tons of U.S. soybeans in late 2025 and at least 25 million metric tons annually from 2026 through 2028. Market reactions. Financial markets experienced volatility during periods of tariff escalation, though they stabilized following diplomatic agreements. Manufacturing and supply chains. U.S. imports of furniture from China fell 22.2% in the first 6 months of 2025 compared to the same period in 2024, with June alone seeing a 53.4% decline from the previous year. Many companies face decisions about absorbing costs, raising prices, or restructuring supply chains. Different perspectives. Arguments for tariffs. Supporters argue that tariffs can address concerns about unfair trade practices, encourage domestic manufacturing, provide leverage in trade negotiations, address national security concerns. Arguments against tariffs. Critics contend that tariffs increase costs for consumers and businesses, can trigger retaliatory measures, disrupt established supply chains, may reduce overall economic growth. Current trade relationship. As of early December 2025, the U.S. and China have extended Section 301 tariff exclusions until November 10, 2026. China has agreed to suspend export controls on rare earth elements, gallium, germanium, antimony, and graphite, issuing general licenses for U.S. end users. The relationship remains complex, with multiple layers of tariffs still in effect, but the October-November 2025 agreement represents significant de-escalation from the April peak. What economists say? Economic research institutions have offered various perspectives. Some economists note that tariffs can serve as negotiating tools but come with economic costs. Others emphasize that the ultimate impact depends on how long tariffs remain in place and how businesses adapt. There is broad agreement that supply chain adjustments take time and that tariff impacts affect different sectors differently. Looking forward, the trade relationship continues to evolve. Key factors to watch include implementation of the November 2025 agreement commitments, whether tariff extensions continue beyond November 2026, how businesses adapt their supply chains, future negotiation outcomes on remaining trade issues. Conclusion. The U.S.-China trade relationship in 2025 has been characterized by both tension and negotiation. While significant challenges emerged, diplomatic engagement led to agreements that reduced some tariff levels and established frameworks for ongoing commerce. The situation remains dynamic, with both economic and geopolitical dimensions continuing to shape policy decisions. For those interested in staying informed, official sources include U.S. Trade Representative Office, USTR.gov, U.S. International Trade Commission, Congressional Research Service reports, academic economic research institutions. Trade policy involves complex economic considerations with legitimate disagreements among experts about optimal approaches. This video aims to present factual information to help viewers understand the issues. U.S.-China Trade Relations Part 2, the 2026 Outlook and Strategic Implications. Introduction. Following our overview of 2025's developments in U.S.-China trade relations, this second part examines what economists and policy analysts expect for 2026, the structural changes underway in the global economy, and the strategic implications for both nations. Economic forecasts for 2026. United States Outlook. According to major financial institutions' projections, Goldman Sachs Research forecasts U.S. growth rate of 2.6% in 2026, supported by tax policy effects, continued AI-driven investment, easing financial conditions, and reduced drag from tariffs following the October-November 2025 agreements. Morgan Stanley projects 2.1% growth, with inflation measured by core PCE expected to reach 2.6% by year-end 2026, declining toward the Fed's 2% target. The Federal Reserve is projected to reduce interest rates to 3.25% during 2026, with most cuts occurring in the first half of the year. China's economic trajectory. China's 2026 outlook presents a more complex picture. Goldman Sachs revised its China forecast upward to 4.8% growth, notably above the IMF's consensus of 4.16%, citing strong export performance in manufacturing sectors, government support through the 15th Five-Year Plan 2026 through 2030, and reduced drag from the property sector downturn. Morgan Stanley forecasts 5% growth for 2026, declining to 4.5% in 2027 as fiscal stimulus effects diminish. However, several analysts note that China's growth composition remains unbalanced, with exports contributing significantly while domestic consumption stays weak. China's strategic response: export diversification. One of the most significant developments has been China's success in diversifying its export markets. Geographic shift. In November 2025 alone, exports to the United States fell 28.6% year-over-year. Exports to Africa increased 27.5%. Exports to Asian countries increased 8.2%. China's trade surplus reached approximately $1.1 trillion for the first 11 months of 2025, on track to exceed $1.2 trillion for the full year, surpassing the 2024 record of $992 billion. Zero tariff initiatives. Beijing has announced zero tariff policies for 53 countries, strategically excluding the United States. This positions China as a more open trading partner while the U.S. pursues protectionist measures. The 15th Five-Year Plan 2026 through 2030. The Chinese Communist Party Central Committee approved its 15th Five-Year Plan in late 2025, with final details expected in March 2026. Key priorities: Industrial upgrading, modernizing traditional industries such as metals, chemicals, and textiles, expanding emerging sectors such as new energy and advanced manufacturing, and increasing competitiveness in high-tech exports. Growth target. The plan implicitly targets approximately 4.5% annual GDP growth through 2030, aiming for China to reach per capita GDP levels of a moderately developed country by 2035. Policy support. Expected measures include interest rate cuts, forecast of 2 10-basis point reductions in 2026, fiscal expansion, credit growth acceleration, and continued investment in AI and advanced manufacturing. Critical minerals and negotiating leverage. A noteworthy aspect of the October-November 2025 trade agreements was China's use of rare earth minerals as negotiating leverage. Strategic resources. China suspended export controls on rare earth elements, gallium, germanium, antimony, and graphite. These materials are critical for electronics manufacturing, defense systems, electric vehicle batteries, and renewable